Hello, and welcome to this 13th episode of Investing Not Rocket Science. Investing doesn't have to be rocket science, and this is our non expert guide to portfolio management. We've been through 12 episodes, and in the first episode, I defined a portfolio framework. This is a $1 million portfolio, and I'm looking to invest into equities and bonds, and I plan to actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the objective of this portfolio is to beat inflation and an equity index. From episodes 2 to 12, I added Google, Emerson, Infineon, UK Guilds, BMW, Deutsche Bank, Citi, ICBC, Glencore, and US Steel to this portfolio. So far, I've analyzed 43 stocks and 4 bond opportunities, and I am long 9 stocks and 1 bond in this portfolio. Today, I'm going to look at a market update and a portfolio update, post which I'm going to evaluate Amazon, Alibaba, eBay, JD.com, and Rakuten. Okay, let's look at a market update. UBS buys Credit Suisse for about 3.25 billion US dollars. And as a part of the deal, Credit Suisse writes off $17 billion worth of bonds. Last week, ECB increased interest rates by 0.5%. And the US CPI for February was at 0.4% increase month on month and 6% year on year. Core CPI continues to increase. In February, it was up 0.5% month on month, and most likely a sign of sticky inflation. Producer price index, however, declined and came in lower than analyst expectations. It declined 0.1% month on month and 4.6% year on year. Producer price index continues to see deceleration. 11 of the largest banks in the US have deposited 30 billion in First Republic Bank to negate the effects of large customer withdrawals at the bank. OpenAI launches new version of GPT, the GPT-4. And Samsung has announced that it'll invest $228 billion into a South Korean semiconductor manufacturing plant. This is expected to be the largest chip factory in the world. Okay. Now, despite a fall in US Treasury yields in the last 1 week and selling pressure on banking stocks, equity indices have closed in the positive. The US equity indices have closed in positive in a week that had the quarterly options expiry as well, driven largely by mega cap stocks such as Google and Nvidia and Microsoft, all of which gained more than 12% last week. Among the S&P 500 sectors, the communication sector was up 6.9% and information technology was up about 5.7%. Crude oil was down 13% as the PPI data likely points to growth concerns. While gold futures was up 4.8% as the CPI print pointed to sticky inflation. Okay, so that's what happened in the markets last week. Let's look at the portfolio. The portfolio is up 0.6%, 0.68%, while the benchmark index is down 5.6%. This portfolio outperformance is largely due to the fact that the equity exposure in this portfolio was gradual, as you can see here. Right? This is the equity exposure, and it has increased over time. Okay. In terms of asset classes, gains in the portfolio has primarily been driven by bonds and the cash holdings. Okay, let's look at regional weights. Asia continues to remain largely underinvested in this portfolio at this point in time at 1%. And the US is at about 51%, and Europe is at about 48% of the holdings. In terms of individual picks, see Google is up about $6,600, and this is the largest gainer in the portfolio at the moment. And Deutsche Bank and Citi are the largest detractors in the portfolio, largely because the financial sector came under a lot of selling pressure last week. Let's continue into the evaluation. Let's look at company financials. Amazon's revenue is larger than the sum of all the other revenues put together. All right. However, in terms of market cap to last 12 months revenue multiples, JD.com is most attractive at about zero point 0.4 multiple, and followed by Rakuten at about zero point 0.5 multiple. Okay, in terms of earnings yield, eBay leads the way with about an 8.1% earnings yield, despite the fact that it is trading at about 2.3 times its annual revenue, followed by 5.1% for Alibaba and 3.6% for JD.com. All right, in terms of unlevered free cash flow, 6.2% for Alibaba and 17.5% for eBay and 1.8% for JD.com. These are the three companies which have positive unlevered free cash flows. Okay. Efficiency, valuation, and volatility. In terms of operating income, it's the highest operating income margin. It is the highest for eBay at about 24.8%, followed by Alibaba at about 12.3%, and Amazon at 2.4, and JD.com at 1.8%. Okay, in terms of PEG ratio, JD.com and eBay have the lowest PEG ratios. In terms of realized volatility, it is high for JD and Amazon. JD and Alibaba, and followed closely by Amazon. All right, eBay and Rakuten have volatilities of about 37%. Let's look at trends in company financials in the last 10-year period. Okay, revenue growth has fallen the most for JD and Alibaba, while Amazon has seen stable revenues, relatively stable revenues in this period. All right, eBay has seen some volatility here in its revenue growth. In terms of operating income margins, again, they've been stable for eBay. So you see eBay's operating income margin there. It has been more stable for eBay. Amazon and JD also have stable, although it's lower, they do have stable operating income margins. All right, let's look at earnings yield. eBay isn't here because the earnings yield was more volatile than the earnings yield of Rakuten, as you can see here. Um, Although low at about 3.6%, earnings yield has actually improved for JD in the last 10 years. Okay. Capital expenditure, it has risen for Amazon and Rakuten, while it remains stable for JD over here at about 1.7% to about 2.1. Okay. In terms of interest expense, it is highest for Amazon and Alibaba, and this is likely to continue rising in a rising interest rate scenario. Unlevered free cash flow, it is declining for all stocks, so that's not really a great sign. However, it is most stable for JD here, which is most stable for JD. Other stocks have seen some volatility in the unlevered free cash flow margin. Okay, in terms of inventories, which is not available for all companies. Highest for Amazon, obviously, because it's a large company. It's about 7% of revenues, and it's likely peaking out for JD here. It's kind of flattened. The inventories are flattened, and for Amazon, it looks like it's topped out. Okay, let's look at fair value and upside potential. Two methods that I'm using for valuations here: the discounted cash flow analysis using Investing Pro and analyst targets. Targets set by analysts could be subjective to their individual bias to the sector or stock, while the DCF model is a more objective method. Both are, of course, important because the analyst could have information that the DCF model will not account for, and therefore, what I generally tend to do is take an average of the two. This tends to provide a sort of a fair assessment. So, on average, Alibaba offers the highest upside potential, followed by JD and eBay. All right. So at the end of this evaluation, I'm going to add JD.com to this portfolio with approximately a 3% exposure. While eBay ticks a few boxes, however, its financial trends are volatile, and I'm not really comfortable looking at eBay at this point in time. Amazon also has stable trends and is really impressive company. It does tick a few boxes, however, it is expensive at this point in time, and it has negative free cash flow. So I'm just going to wait out one more quarter and assess their financial results and take a decision on Amazon post that. All right. Let's look at the charts. It has a 60% volatility, so that's a risk that I will be taking on this portfolio with an addition of JD to it. So at the end of this evaluation, it's buy JD.com and put Alibaba, Rakuten, and eBay on the watch list. Amazon's already there. In the next video, I'm going to look at stocks from the real estate sector. I have delayed that evaluation until the FOMC interest rate decision and their financial projections and press conference this week. And as equity markets become more volatile, I'm also going to evaluate hedges to the equity exposure. And, let's see where that leads us. All right. Thank you very much for your time. This is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Please visit our website for full disclaimers in terms of use. You can also follow the blog on claritech.app. Or you can follow our social media channels. Thank you once again, and I look forward to seeing you in the upcoming videos.